So we're going to move on to number 4. I do apologize for this being split into 2 videos, but I had some unexpected stuff happen at the house that it made me take a break for a few minutes. So we're going to pick back up on number 4, and we're going to try to finish this video out as just the 2 pieces. So questions 1 through 3, and then 4 through 18. So we'll pick up here with number 4, and on number 4 we're looking at natural resources and depletion. Now be very careful because this is depletion, which is different from depreciation. So for depreciation, that's when we're talking about that is when we're talking about your physical assets, property, plant, equipment, right? We've got buildings, we've got machinery, all that type of stuff. Depletion, on the other hand, is only used when we're talking about our natural resources. So do make sure you're aware of the difference in that terminology so that you don't get confused. So what I'm telling you here is if I were to ask you a question on an exam that says something like, what is the primary difference between depreciation and depletion? Well, the answer, of course, is that depreciation is for those long-lived assets, whereas depletion is for those natural resources. So I want to make sure we have a good understanding of the terminology that we're going to be seeing in this chapter. So let's see how we actually compute this in this case. So this question tells us Perez Company acquires an ore mine at a cost of $1,960,000 and incurs additional costs of $548,800 to access the mine. There is estimated to be 1.4 million tons of ore, and 200,000 tons are mined and sold the first year. The estimated value of land after the ore is removed is $280,000. Calculate the depletion expense from the information given. So in this case, we're not going to use straight line depreciation like we did before. We're not going to use straight line depletion. Instead, what we're going to use is what is called the units of production method. And with the units of production method, what we're going to see is that the formula changes just a little. So in this case, the formula becomes cost minus salvage value divided by total estimated units. And that's going to equal my rate per unit. Then I'm going to have to take my rate per unit and multiply that by my units used in current period. Okay. So now we're actually going to plug in these numbers. So the way we're going to do this is I'm just going to scribble out these formulas. And I'll just rewrite this with the actual numbers that we need. So the top part here is going to take my cost of $1,960,000. Then I'm going to add my additional costs of $548,800 because that is cost to access the mine. And if I'm to use this mine, I have to be able to access it, which means that this falls under that third piece that we talked about earlier when we talked about what costs get included. And we said any and all costs necessary to be able to make the item ready and capable for its intended use. And in this case, that is those access fees of $548,000. We will then subtract the salvage value, which it tells us is $280,000. We'll then divide this entire numerator by my total tonnage of 1,400,000 tons, and that falls right here. Then that will give me a rate per ton, which comes out to $1.59.2. So that is exactly what we see. So 1.592 is what we get for our rate, and it tells us in this year that we actually used 200,000 tons of ore. So I'll then take this and multiply by my 200,000 tons. This is $1.592 per ton. And when I do that multiplication, what I should come out to is 318,400 $400 in total depletion expense for this current year. So what we're going to look at next is what that journal entry looks like. And so there are actually two journal entries I want us to make here. The first is to record the purchase of the ore mine, and the second is to record the depletion associated with that ore mine. So what we'll do is we'll take this 2,508,800 that we calculated on the prior page, and if you want to see that, that is just the sum of those two numbers. We'll debit the ore mine, which is an asset. Assets go on the balance sheet and increase with a debit, and we paid for that with cash, which is an asset, which goes on the balance sheet, which decreases with a credit. Now for the next journal entry, this is just our typical depreciation journal entry, but in this case, just be very careful and replace that word depreciation with depletion. So in this case, we'll debit depletion expense dash ore mine, dash my ore mine. Then we're going to credit accumulated depletion dash ore mine. And just like we did on the last journal entry, we'll go ahead and analyze what these actually are. So the first item here, depletion expense, well, that is an expense that will go on the income statement, and it is increasing since it is being debited. And the second here is my accumulated depletion. And accumulated depletion is a contra asset, so CA. And don't be confused and think this is a current asset, right? Sometimes I'll use the abbreviation CA for current asset, but in this case, CA stands for contra asset. Contra assets go on the balance sheet with their related assets, and they also increase with a credit. So there we have it. And that is the end of question number 4. So now we're going to move on to question number 5. So for question number 5, what we see is that we're going to be classifying assets as either intangible, natural resources, or something else. Okay, and so that's what we're going to do here. So what is an intangible asset? Right, this is something we haven't really talked about up to this point in the semester. And what an intangible asset is, it is something that does not have its value in what it actually is. Sounds a little confusing, so let's unpack that a bit. So an intangible asset, when we think of those, we tend to think of things like copyrights, licenses, software, trademarks, goodwill, etc. Okay, so that is what we're doing here. And this is what we're looking at is, well, what type of assets are these? And then we'll look at how we handle each type of asset. Okay, so as we go through this, just keep in mind what we're trying to do right now is just identify what we have. And then in later questions, we'll look at how we actually do the accounting for these. So for the first one, we see copyrights. Well, copyrights are an intangible asset. Licenses also are an intangible asset. Standing timber, this is a natural resource because that is a natural resource, right? So hopefully that one is pretty easy for us. Next, we've got software. Software is also an intangible asset. Leasehold improvements, don't worry too much about this one, but do be aware that that is also classified as an intangible asset. Trademarks, these are intangible assets. Gas fields, oil fields, and gold mines, of course, are all natural resources. So all 3 of these are natural resources. And that wraps up number 5. So we'll move on to number 6. And in number 6, we're going to look at what is called amortization. So amortization is basically what we do with depreciation and depletion, but when we deal with intangible assets, it now has a special name. And that special name is amortization. So just to recap, when we're dealing with physical assets, the systematic devaluation there is called depreciation. When we're dealing with natural resources, the systematic devaluation is referred to as depletion. And when we're dealing with intangible assets, that systematic devaluation is known as amortization. Okay, so that's all we see here. So this question tells us that on January the 1st of this year, Diaz Boutique pays $130,000 to modernize its store. Improvements include new floors, ceilings, wiring, and wall coverings. These improvements are estimated to yield benefits for 8 years. And Diaz leases but does not own its store. It has 5 years remaining on the lease. So what this means is that yes, we are going to benefit from these improvements. But since my lease term is only for 5 years, even though these improvements themselves are good for 8 years, I'm not going to be able to use that 8 to amortize this down. Instead, what I'm going to have to do is use the lesser of that benefit time of 8 years or the time remaining in the lease. And since 5 years is less than 8 years, we will use 5 years. Okay? So we will use 5 years for our amortization calculations. So in this case, we're going to calculate amortization, and they tell us at the end of the current year. Now, if they don't tell us which method to use, we assume straight line. So straight line be cost minus salvage value divided by life. And in this case, our cost was $130,000. There is no salvage value because we're not going to be there anymore, so we're not going to be getting any benefit, and it's not going to be worth anything. Divide that by my 5 years, and when I do that, I'll come out to $26,000 per year in amortization expense. So what we're going to do is we're going to look at 2 journal entries. So the first journal entry we're going to look at deals with how we record the purchase of this asset. So we first debit what is called leasehold improvements, which is how we're going to track these changes or these improvements to the property that we have under lease. And next, what we're going to do is come in and credit cash. Okay? So debit to leasehold improvements and a credit to cash will take us through the first entry. And the second entry, we're going to debit amortization expense, leasehold improvements, and we're going to credit accumulated amortization. So very similar to what we've been seeing, where we've been seeing things where we take a debit to depreciation expense, a credit to accumulated depreciation, or for natural resources, where we take a debit to depletion expense and a credit to accumulated depletion. Well, the same thing is true here with our amortization. So we debit amortization expense and we credit accumulated amortization. Just make sure you know when to use which term, okay, because they are a little bit different. So now for the next question, we're going to look at a ratio. And here we're going to look at how we compute total asset turnover. So it tells us an eco company reports the following: net sales of $19,000 for year 2, $18,050 for year 1, and end of year total assets of $18,600 for year 2, $17,400 for year 1, and they want us to compute total asset turnover as of year 2. So the formula here is going to be for total asset turnover, I'm going to abbreviate this as TAT, that will equal my net sales in year 2 divided by my average total assets for years 1 and 2. So when I do this, I'll take my $19,000 in sales. I will divide that by my $18,600 in year-end assets for year 2, plus my $17,400 in year-end assets for year 1, divide that by 2. So now I can rewrite this as $19,000 divided by $18,000, and this comes out to 1.06 times. And that's all we see here. So we get total asset turnover of 1.06. Now the question tells us a Nico's competitor has a total asset turnover of 2.0. Is a Nico better or worse based on this? Well, if we are performing at a total asset turnover of only 1.06, and that is indeed less than 2, we are worse than our competitor. And that seems to make some sense, because that means we're not generating as many sales per dollar of total assets, which means we are not being as efficient with our assets. So that handles the end of number 7. And so now we'll move on to number 8. So for number 8 here, we're looking at the cost of plant assets. So it tells us here that Rizzio Company purchases a machine for $14,000. Terms 210 net 60 FOB shipping point. Rizzio paid within the discount period and took the $280 discount. Transportation was $316 and was paid by Rizzio, which we already knew, of course, because that is FOB shipping point. So whether this piece right here that I'm about to highlight was actually included, you should have been able to ascertain this, that transportation was paid by Rizzio, because Rizzio purchased FOB shipping point. An FOB shipping point means that ownership changes hands as soon as that material is loaded on the truck and shipped off. So as soon as that was shipped, that no longer belonged to the seller, but instead belonged to Rizzio. And if it belongs to Rizzio, then Rizzio must pay the shipping. So it tells us here that the machine required mounting and power connections costing $968. Another $456 is paid to assemble the machine, and $40 of materials were used to get it into operation. During installation, we are told that the machine was damaged and $355 worth of repairs were made. So what they ask us to do here is to complete the table below to calculate the cost recorded for this machine. So they're asking us how much should be capitalized. Is it all of it? Is it none of it? Is it part of it? Some of it? Right? We don't know. So that's what we're going to look at here. So the very first spot we want to start is with the actual invoice price of the machine. And that part's pretty easy. Okay, so they tell us right here, I'm going to highlight everything as I talk about it in this red color so it stands out. So they tell us that we purchased this for $14,000. So that just falls right there. Just pulls straight down. Now they tell us that we actually did pay within the discount period. So we did pay within the discount period and took the $280 discount. So if you look at this, you say, well, why on earth is that as a negative? And that is because of something known as the historical cost principle. And what this says is that we record assets, at least in GAAP, right, at cost. And what that means is that if I did not pay that $280 because I got a discount, then I have to reduce the value of my equipment by that $280. And that's exactly what you see happening here. So we said, while originally it was billed for more, we're not actually going to pay that $280, so we're going to reduce the value of that asset. Now it tells us transportation costs of $316 were paid by Rizzio, so $316 paid by Rizzio, and that falls to here. All right, this $13,720 is just this $14,000 less the $280. Okay. Next line here tells us about mounting and power connections. So mounting and power connections cost $968, and that gets added to the cost because that is necessary and required to make this machine functional. Next, we need to look at the $456 that is paid to assemble the machine, and that is also required. Finally, we have to adjust the machine to get it into operation. Well, without that, the machine would not be operational, so that is also required. The question is this installation that has the damage? So it says during installation, the machine was damaged and $355 worth of repairs were made. is that $355 going to be capitalized as part of this asset on the balance sheet? And the answer is no, because that $355 is not an ordinary cost associated with getting this machine ready and working. There was a mistake made, and there had to be repairs. While that happens, and that is fine, that is not a capitalizable event. So instead, that has to be expensed on the income statement during the year. So what we're going to see is that if you go through this and you take your 14,000 minus the 280 plus 316 plus 968 plus 456 plus 40, your total cost to be recorded is $15,500. And that takes you through to the end of number 8. Okay. Now for the next piece here, what we see is that Kayla Manufacturing purchases land for $263,000 as part of its plans to build a new plant. The company pays $30,300 to tear down an old building on the lot and $44,791 to fill and level the lot. It also pays construction costs of $1,552,000 for the new building, $97,986 for lighting, and paving of a parking area. So what you're going to have to do here is you're going to have to figure out the cost of the land. You're going to have to figure out the cost of the land improvements. And you're going to have to figure out the cost of the building. So we'll go through this and talk about where each one of these costs is going to land and how we're going to build up to these totals. So I'm going to erase all this underlining so we can see a little bit easier. And we'll just go through it. So Kayla Manufacturing purchases land for $263,000. Well, if that is a land purchase, it seems to me that that would make sense that that 263 would go with the land account. Then it says the company pays $30,300 to tear down an old building on the lot and $45,000 to fill and level the lot. Both of these expenses are also going to be sent to our land account. Okay, so we'll do that. That will bring me to a total of $338,091 for my land. Next, what I'll need to do is to pay construction cost of $1,552,300 for the new building. So that seems to me to be pretty clearly as part of my building costs, $1,552,300. And next, I'm going to have to figure out what to do with this lighting and paving of the parking area. Well, that is going to go to what we call land improvements, $97,986. So we've got our totals. Now all that's left is to make our actual journal entry. So for the land account, we're going to put in this $338,091. For land improvements, it'll be $97,986. And for the building, $1,552,300. And you may be asking yourself, why does it matter if I include this as part of land or as part of land improvements and buildings? And the answer is this: land cannot be depreciated. Land cannot be depreciated. Did you catch that? Which means land improvements and building, these can be depreciated. Since both of these can actually be depreciated and land cannot, land must be accounted for separately. And since the building and the land improvements likely have different useful lives and different salvage values and everything else, those are going to have to be depreciated separately. So remember, land cannot be depreciated. So can not be depreciated, which means we have to account for it separately from our depreciable assets. And then, of course, cash, as the last part of our journal entry, is just the sum of these three items to make the journal entry balance. And that's it. That's all there is to number 9. Now we're going to move on to number 10. And in number 10, we're looking at what happens when we have a lump sum purchase of plant assets. So we're told Rodriguez Company pays $321,165 for real estate with land improvements, and a building. The land is appraised at $202,500. Land improvements are appraised at $67,500, and the building is appraised at $180,000. So what you're going to have to figure out first is the total cost of the acquisition. And in this case, that is $321,165, which they told us is how much we actually paid. The next thing you're going to have to do is figure out the total value of the appraised assets. So, in this question, we are given the following amounts: $202,500 for land, $67,500 for land improvements, and $180,000 for the building. If you take the sum of all three of those, what you come out to is $450,000. But can I record my land at $202,500? Can I record my land improvements at $67,500 and my building at $180,000? Can I? Well, the answer, of course, is no. And the reason this is no is because we only paid $321,165. So we cannot show these assets valued at $450,000. And you may be asking yourself, well, why not? We got a great deal. So why do we have to write down our assets? And I would refer you once again back to what we talked about earlier, which is the historical cost principle. And this says we can only record assets at what we actually paid for them. Since we got a discount in this case, or we got a good deal, those assets are going to have to be reported at that lower value. Okay, so that's what's going on first. Then for each one, so we'll take land for example, we'll take the appraised value, we'll divide it by the total value of $450,000, and we'll see that that comes out to be 45%, and we'll do that for each of the other two as well. Then I'll take that 45%, I'll multiply that by my actual purchase price of $321,165, and that will give me $144,524.25. So this is the amount that land will be recorded at. Okay, and hopefully that makes sense. Now, if you were to do this for the other two, of course, you would take your $67,500, and that would go right here instead of this 202. The 450 would not change. Then you would end up with that being 15%. You would multiply that 15% by the 321,165, and you would come out to this 48,174.75, and that will carry you through to the end of number 10. Now, or at least number 10, part 1. The next piece here, of course, is the journal entry for this. So for the journal entry, we'll just go back to that prior question, pull in those balances, and we know, of course, that credit is going straight to cash for the 321,165. In this case, all of these are assets. They all go on the balance sheet. And the first three here, land improvements, and building, are all going up. And the last one, cash, is of course going down. And that's all that we see on number 10. So now we'll move on to numbers 11 through 13. So this question tells us that Ramirez Company installs a computerized manufacturing machine in its factory at the beginning of the year at a cost of $86,200. The machine's useful life is estimated at 10 years and 396,000 units of product with a $7,000 salvage value. During its second year, the machine produces 33,600 units of product. So, in this question, the first thing we're going to do is calculate this for our straight line depreciation. So we said straight line depreciation was cost minus salvage divided by my estimated life times my portion of the year. Now, real quick, what else could salvage be called? Okay. So you could also see salvage called remaining value at the end of the life, residual value, anything like that that's talking about the value that's left once this thing is fully depreciated is what we're going to use for this salvage value part of this calculation. Now, the term salvage value itself is used quite often, but if you ever were to see it worded slightly differently, hopefully you'd be able to figure out exactly what they were trying to tell you. Okay? So for this question, we see that the cost was $86,200. I'll switch over to my red so we can highlight that. There's my $86,200, a $7,000 salvage value. So that is how they get this $79,200, is by taking the 86 minus the 7. We are then told that the estimated useful life is 10 years, so that drops in right here as my estimated useful life, which tells me that each year I'll take $79,200, divide that by 10, and I'll come out to $7,920 in depreciation expense. Now that will be true for year 1, that will also be true for year 2. And at the end of year 2, my year-end book value will be $70,360. And that is because it tells us that we bought this machine at the beginning of the year. So we'll take that cost of $86,200 minus $7,920, but be very careful here. It is asking at the end of year 2, not year 1. So we'll then take the $7,920 out again, and that will bring you down to $70,360 for your ending book value. Now, another question I could ask you, right? This question doesn't, but I could ask you, instead of calculating my ending book value, I could ask you, well, what is my balance in accumulated depreciation at year 2 end? And in that case, it would be the sum of my $7,920 plus my $7,920. So that would be $15,840. And that's all there is to that. So just be aware all the different questions I could ask you and how you would do each one of those. So now we'll move on to number 12. So with number 12, it tells us we want to determine the machine's second year depreciation using the units of production method. So if you recall back up here, it told us that we estimated a total units of product of 396 and that we were going to produce 34,000 units of product, or 33,600 units rather, in this second year. So what I'm going to do is I'm going to come down here. I'm going to keep my cost minus salvage value the same, so it's still 86,200 minus 7,000. But now I'm going to divide this by my total units of production, which will give me 20 cents per unit. I will then multiply that by my units produced during the year. 20 cents times 33,600, and when I do that, I get $6,720 in depreciation expense. Now you may notice that one of the key differences here between number 12 and number 11 is that in number 11, I told you we may need to factor in the percentage of the year. However, in number 12, I mentioned nothing about time, and that is because that is already inherently factored into the calculation. If I buy a piece of machinery at the beginning of December and only have it for 1 month before the end of the year, it makes sense that I'm going to use that machine less than a piece of machinery that I buy on January 1st that I have the entire 12 months to use. So the units of production method already accounts for time, just in a little bit different manner. So that takes us through to the end of number 12. And for number 13, we're going to look at what is called the double declining balance method of depreciation. Now, the way that this works is double declining balance gives you 2 times the rate. So double declining balance, DDB, gives 2 times the straight line rate, not 2 times the straight line amount. And you say, well, how does that make sense at all? So what we're going to do is I'm going to show you the formula for double declining balance, and then I'll ask you a quick question and see if you're following along well. So the first thing that we're going to look at is for double declining balance, the formula for this depreciation that I'm going to suggest you use is 200% divided by life times portion of the year. Now, how is this going to work? So, here what we're going to do is we're going to have to figure out what is going on. Of course, this will then be times our cost. Okay. So, under the straight line method, we account for salvage value at the very beginning of the calculation. And that's what we're doing when we take cost minus salvage value, is we're going ahead and ensuring that we cannot over depreciate this asset by accounting for that depreciation that needs to be left off through the form of salvage value at the very beginning when we first purchase the asset. Double declining balance does not do that. Double declining balance is an accelerated depreciation method where we're trying to get the benefits of this tax write-off a little bit earlier, either for that reason or because this actually better represents the use of our equipment. We say at the beginning of the life of the asset, we're going to use this very heavily, but as it gets older, we're probably going to use it less and less. A good example for this is if you think about a forklift. If you think about a forklift that is brand new, it runs really nice and smooth. It has no problems. However, about year 7 or 8 on that thing, that forklift is starting to look pretty raggedy, pretty run down, runs a little bit slower, a little bit clunkier. So we're not going to be able to get as much value out of that forklift in year 7 or 8 as we did in year 1. So we're going to assign less expense. And this is really trying to deal with that matching principle of matching the associated depreciation expense up with the revenue that expense helped us generate. So all kinds of arguments for straight line versus double declining versus units of production. Really what we're trying to do is keep it where we get a good representation of exactly what's happening, and we can match these expenses to the revenues as closely as possible. So now what we're going to look at is how this actually works in this question. So give me just a second to clear this out. And what we're going to do is we're going to come in, I'm going to say, in this case, we were told that there was a 10-year life. So if I take 200% divided by my life, which is 10, I multiply that. We were told that this happened at the beginning of the year, so it'll be just 12 over 12, so I'm going to leave that out. But here, I'm going to do it by my beginning book value. Now earlier I wrote cost, and that was just kind of a shorthand for what we're really meaning here, which is beginning book value. So at the beginning of each year, we're going to have to find a new number. So in the first year, it told me the cost was $86,200. So I can just use that full $86,200. So I'll take $86,200 times 200% divided by 10. And this right here will come out to 20%. So 86,200 times a rewritten 20%. And that comes out to 17,240 for depreciation expense in the first year. Now in year 2, the way we're going to calculate depreciation is I'm going to have to come in and take my 86,200 minus my 17,240. Then I'll multiply that number, whatever that is, which in this case it is 68,960, times my 20%. And when I do that, I'll get $13,792 in depreciation expense for year 2. So you see that from year 1 to 2, we recorded far more depreciation in year 1 than in year 2. This continues down throughout future years, And in a further question, we'll actually look at how we stop depreciation in that final year to prevent us from over depreciating the asset. In this question, that's not what we're asked to do, so we're going to leave it here for number 13. So that covers 3 methods of depreciation so far. So for number 14, what we're going to look at, once again, is just basic straight line depreciation. So for straight line depreciation, we hopefully know this formula by heart now. It'll be cost minus salvage divided by life times time. Okay. So they tell us here, New Tech purchases computer equipment for $273 to use in operating activities for the next 4 years. It estimates the equipment salvage is $26,000. Now they didn't tell us when we purchased this during the year, so since they didn't tell me, I have to assume that I purchased this at the beginning of the year. So what we're going to do, I'm going to take my $273,000. I'm going to back out my salvage value of $26,000. And I'm going to divide this by 4 years. When I do that, I get an annual depreciation expense of $61,750. So that is where we are right now. So now that I've got that out of the way, what I've got to do is figure out for each year exactly what my year-end book value is, just so I can prove out that this depreciation is working properly. So before you even do this depreciation, if I asked you in a multiple choice question, say, instead of this being 4 years, I made this 25 years. And I asked you, well, what is that year-end book value at the end of year 25? How could you get that answer? Could you sit here and draw at a table like this and go down all the way to year 25? Absolutely. Is that very effective? Is that how you're going to finish the exam on time? Absolutely not. Right? Instead, what you can do is say, look, at the end of year 25, this piece of equipment will be fully depreciated. And the value of a piece of equipment when it is fully depreciated is equal to the salvage value, which means that all you have to do, if I ask you a question about what the value of a piece of equipment is at the end of its life, is tell me what the salvage value is. Because at the end of year 4, and this had a 4-year life, you see, the year-end book value is $26,000, which is, of course, the salvage value. So don't get confused. Don't let me trip you up on the exam and have you sit here and work out a ton of stuff that there's not going to be room for, and you're going to get frustrated, and you're going to feel crunched for time. Don't do that. Instead, realize what the concepts are telling you, look at this question, identify the answer, and move on. Now, in this question, we're asked to do a little bit more than that, so we'll go ahead and walk through exactly how this will work. So since this is straight line depreciation, depreciation is the same in all 4 years. The only way this would change, of course, is if this machinery was not bought at the beginning of the year. Maybe it was bought April 1st, then that first year and that last year will be off a little bit because we'll have some moving around that has to happen, but no big deal there, and we would deal with that like we will, I believe, in a question later on in the homework. So now that brings us to the end of that piece of this question, and finally we need to look at my year-end book value. So the way I'm going to do this is I'm going to take my cost, which was $273,000, so 273, minus my accumulated depreciation, and that will give me my year-end book value. So in this case, I'll back out $61,750, and that will give me my year-end book value for year 1 of $211,250. Now, for year 2, I can just keep this going, $211,250 minus my accumulated depreciation, or really, I'm sorry, not accumulated depreciation in this case. This would be minus depreciation expense, because we don't want to double count this. We just want to take this right here, minus that, and that will give me that $149,500. So then I'll back out my $61,750. That'll give me $149,500. And you can follow this down all the way through if you wish. This is our new book value. This is my depreciation expense, my old book value, and you can go down like that. Maybe a more clear way to do this, though, is to always just bring this back to cost minus accumulated depreciation. If you did that, here's how that would look. I would take my cost of 273 minus my 61,750. That would bring me down to 211,250. Then for year 2, I could take 273,000 minus 61,750 for year 1, minus 61,750 for year 2. And when I do that, I would also come down to my 149,500. For year 3, I would take 273 minus 61,750 minus 61,750 minus 61,750. And when I do that, I would then come down to my 87,750. So however you choose to do this is fine, and then I would do the same thing for year 4. Of course, you can multiply this out if you wish and take 61,750 times 2 and back that out. But just so you can see the pattern, I went ahead and wrote it out here. But if you're comfortable doing that multiplication, do feel free to do so. It's a little bit quicker than what I just did. Now, one other thing I want to point out is what amount of depreciation would be recorded in year 5. So this thing is fully depreciated at the end of year 4, but at the end of year 5, if we continue to use this machinery, how much depreciation expense would we need to assign this piece of equipment? And the answer is 0. Year 5 and on, so let's just see here. So from year 5 through infinity, no depreciation will be recorded because it's already fully depreciated. Of course, the only way that there would be depreciation here would be if there's a prospective change in an estimate that we needed to account for. In this case, that didn't happen, so no more depreciation to be recorded here. So that brings us to the end of 14, and we'll move on to number 15. Now, 15, we're going to look at the double declining balance of depreciation. So it tells us to prepare a table showing depreciation and book value for each of the 4 years, assuming the double declining balance method. So in this case, what we're going to look at on the far left is my beginning of year book value of $273,000, which of course is the cost of that machinery. Then we will take, since this is a 4-year life, we will take 200% divided by 4, which will give me 50% as my rate. That rate will stay the same in all 4 years. Now my annual depreciation, this column right here, is my beginning book value times my depreciation rate. And this works most of the time. So I'm going to kind of box this in, and I'm going to put an asterisk on it because there is one exception, but we'll deal with that when we get to it. So in this case, my annual depreciation is $136,500. My accumulated depreciation in year 1 then is just that same $136,500. And if I was to take my cost of $273,000 minus $136,500, what I would be left with then is $136,500, and this will flow through to right there. And that's all we have for year 1. Now for year 2, we got to be a little careful, because for year 2, what we're going to have to do is take this end of year book value, so this right here, this $136,500, and it will now be transferred to right here, because what was the year-end book value for year 1 will become the beginning of year book value for year 2. It just flows straight over. We continue to use the same 50% depreciation rate, but now we apply that 50% to $136,500. Of course, 50% of $136,500 will give you $68,250. Then you'll take your $136,500, which was your beginning of year book value of that $136,500, back out the $68,250 in current year depreciation expense, and you'll be left with $68,250 as your year-end book value. Now the question is, well, how on earth do we go from right here of 136,500 in accumulated depreciation down to 204,750. And the way is by adding these numbers that you're about to see highlighted in purple. So if I take this 136,500 in accumulated depreciation from year 1, I add in my depreciation expense from year 2, the sum of those two numbers will then give me this 204,750. So I'll just show you that real quick. So 136,500 plus my 68,250 will give me 204,750 in accumulated depreciation. Now you'll follow the same pattern all the way down through the rest of this table, and that'll bring you to that last row. I'm going to talk through it, but I'm not going to show quite as many notes just to help us not spend too long on this, because I know this video is already getting quite lengthy. So for year 3, I'm going to transfer this year-end book value right here to my beginning of year book value in year 3. I'm still using the same 50%. 50% of 68,250 gives you 34,125. I'll then add my 204 and my 34 to give me to 238. And then I will take my 68,250 less my current year annual depreciation of 34,125, and that brings me down to what is left of 34,125. Now, in this case, if you look from 34,125, the distance down to $26,000, which is our salvage value, is $8,125. But if you use the same pattern of 34,125 times 50%, that does not equal 8,125. In fact, it's a little over $17,000, which means something else is going on here. So why on earth did I not use the same pattern? Well, that's because I cannot depreciate past salvage value. So when I get to that last year, or any year for that matter, I need to make sure I'm not depreciating past salvage value, because double declining balance does not consider salvage value at all until the end of the period. So whereas in our other methods we take salvage value out at the beginning, the double declining balance method does not do that. So we have to make sure we don't forget and we actually do account for that here. So that's the way that we get this $8,125 is by making it a plug figure for the difference between the $34,125, which is my beginning of the year book value for year 4, and what my salvage value actually needs to be. This right here gives me my year 4 depreciation. And this is why this had an asterisk earlier, is because in that last year, this formula may not work. And in fact, most likely will not work. Okay? And so that is all we have here. That brings us to the end of number 15. So with that, we will move on to number 16. So 16 and 17 are basically a pair, so we're going to look at those together. So for 16, what we are told is that on April 1st, Cyclone Company purchases a trencher for $314, and the machine is expected to last 5 years and have a salvage value of $57,000. Now, if you're in a hurry and you're working this question very quickly, you may fall prey to this little trick here. Did you notice that I said on April 1st, not January 1st? What that means is that since I'm using straight line depreciation, I'm going to have to account for that date. So I did not own this machinery for the entire year, which means that first year's depreciation is only for a partial year. So in this case, I'll take my cost of $314,000, back out my salvage value of $57,000, divide that by 5 years, and multiply this by 9 months divided by 12 months. The way I would do this if I was taking an exam is I would actually count this out on my fingers, and I would say, how many months did we own this machinery? We owned it for all of April, all of May, all of June, July, August, September, October, November, December. And if you do that, you'll see you actually had this for 9 full months. The reason I encourage you to do this on your fingers is we may not always buy assets at the beginning of the month. We may buy this on the last day of April,
instead of the first day of April, in which case the month of April does not count. So don't just see the month, see the date as well, and don't let that trick you. So in this case, when you do this math, you'll come out to $38,550 for year one depreciation. Now, earlier I told you straight line depreciation gives you the same amount of depreciation every year, but in this case, that will not be the case. And that is because this is one of our exceptions. If you've learned anything about accounting this semester, hopefully you've learned there's an exception for everything. And that is true here. Because this was not bought at the beginning of the period, even though we're using straight line depreciation, depreciation will vary between periods, at least between the first and second year. Right? The third year would have the same amount of depreciation as the second year because at that point it turns into what we think of as traditional straight line. But for the first year, it's this $38,550. For year two, what we're going to have to do is come in, we'll take our $314,000 minus my $57,000, divide that by 5 years, and that'll come out to $51,400. And that's it. That's all there is. And that gives us first and second year depreciation on a straight line basis. So hopefully that one makes sense. And now that we've knocked that one out, we will move on to 17. Now for 17, we're going to look at this with double declining balance and partial year depreciation. So in this case, we're computing depreciation expense at December 31st for the first year and second year, assuming the company uses the declining balance method, specifically the double declining balance method. So in this case, what we're going to look at is the beginning of period value, $314,000, times what ratio? Well, this will be 200% divided by 5 years, which this right here could just be rewritten simply as 40%. But then we have to multiply this by the period of time. So since we only owned this for 9 of 12 months, we'll multiply that out. And when we do, we get $94,200 in depreciation expense for year one. Now, be very careful. This right here is 2 times the straight line rate. Straight line rate, of course, being 20%. But if you look, $94,200 is not 2 times $38,550, nor is it 2 times $51,400. Please, 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 if you get a question on double declining balance, do not take that straight line amount and multiply it by 2. It will be wrong basically every time, ever. So don't do that. Instead, realize double declining balance gives you 2 times the straight line rate. Okay, so here with this straight line question, we were dividing over 5 years. Well, 1 over 5 is 20%. And so we see in double declining, we are using 40%, which is in fact 2 times that straight line rate. These differences, of course, occur because in straight line, we do account for the salvage value at the beginning of the period, but in double declining balance, we do not. And that is why you cannot just take 2 times the straight line amount to get your double declining balance amount. So please do be very careful. Now for year two, what we're going to have to do is take that beginning balance of 314, back out the depreciation we've already recorded of 94,200. Then we'll multiply that times my 40%, and that will give me $87,920 in depreciation expense for year two. You'll notice here, this is times 12 over 12 for the full year because we bought it in the first year, but by the second year we've had it the whole time. So we're able to use the full 12 months. Then to get our total accumulated depreciation, it is simply the sum of all years' depreciation expense. Now, to show you this, I'm going to drop a table real quick and erase some of this so that you can hopefully visualize this in a little bit better manner. So what I'm going to do is I'm going to show depreciation expense and accumulated depreciation on the left, and I'm going to show year one, and year 2 across the top. So you'll notice that depreciation expense in year 1 is just this $94,200. And in year 2, it is $87,920. However, the accumulated depreciation in year 1 is still $94,200, but in year 2, that changes to be $182,120. And this is because depreciation expense tracks depreciation for one individual year and goes on the income statement. But accumulated depreciation tracks all depreciation expense over the entire life of the asset and therefore goes on the balance sheet specifically as a contra asset account. So that's the difference in what we mean when we're talking about depreciation expense and accumulated depreciation. So that handles number 17, and with that we'll move on to our last question, which is number 18. And with 18, we're going to look at the disposal of assets. So what happens when we actually sell off or get rid of an asset? And that's what we're going to see here. So we're going to look at this in 4 separate cases. And this question tells us the DS company owns a machine cost $126,100 with accumulated depreciation of $92,200. Prepare the entry to record the disposal of the machine on January 1 in each separate situation. Now, because this is being sold on January 1, there's no need to record current year depreciation because we're actually selling it at the beginning of the year. So we avoided that piece. Now, this tells us the machine needed extensive repairs and was not worth repairing. They disposed of the machine and received nothing. So what we're going to have to do is figure out how on earth do we make this entry balance. So the first thing I would do, is I would start with a debit to accumulated depreciation on my machine for the full amount, whatever that was, $92,200. Then I would credit my machine for the full amount, which is the $126,100 that we bought the machine for way up here. So I see originally I've got a debit to accumulated depreciation for that machine because, as we've said in this video, accumulated depreciation is a contra asset. Contra assets increase with a credit. So if I'm selling this asset, I need to remove not only the asset, but also the contra asset. To make that contra asset decrease, I then have to debit the accumulated depreciation for that machine, which is driving this balance down to 0. And I have to credit my machine itself for the full 126, which is driving that balance down to 0. Now, if you look, debits do not equal credits. So you got 2 options here. One, you can leave this not balanced and lose the points, right? We don't want to do that option. So option 2, which is the correct option, is to figure out what account we're going to utilize to make this balance. So if you just do this real quick, you can see we're out of balance by the difference between these two, which comes out to be $33,900. So if you want, you could always just start by plugging that in. A debit for $33,900. And see, by skipping that line in the middle, it allowed me to figure out all the debits and credits I know from the facts and then figure out, well, where do I need to put this last piece? So it lets me do that pretty easily. So now I say, okay, well, that's great, but what account does that actually hit? And in this case, what we're going to use is loss on disposal of machine. Okay. And a loss account gets reported on the income statement. So that will be an income statement account. It's treated very similarly to an expense. So it will reduce that income, and it is therefore increasing with a debit. So we're moving through this nice and well. That handles situation number 1. So now we're going to move on to situation number 2. In situation number 2, what we're going to look at is, well, now we sold the machine, but we sold it for $17,300. So you say, well, that sounds better, right? We got something for it. The question is, did we get enough? So let's see. Let's start with the easy part. I'm going to debit cash. for what I got, $17,300. Then I'm going to debit accumulated depreciation dash machine, and that'll be for my $92,200. Okay. Now I'm going to credit my machine for $126,100. The question is 17 plus 92 more or less than 126? And of course it is less. Specifically, that is $109,500. So you say, well, great, debits are less than credits, which means I need another debit. If I need another debit, that means that what I have is a loss. So I will debit a loss on sale of machinery. So do notice this is loss on sale of machinery. Earlier this was loss on disposal. So make sure you do get that terminology right as well. So now this in our full of our debits will equal our total credit of that 126,100. So that handles the second situation as well. Once again, cash and accumulated depreciation go on the balance sheet. The machine goes on the balance sheet as well, and the loss will move to the income statement. So that handles number 2. Moving on to number 3 then. What they tell us here is that we sold this machine again, but now we sold it for $33,900. So here if I debit cash for $33,900 and I debit my accumulated depreciation dash machine for $92,200, credit my equipment account for $126,100, what you'll see is this right here totals out to $126,100, which means there is no gain or loss in situation number 3, and that is because we sold this at book value. So when you get a question like this, what you may want to do, and I'm not requiring you to do this, right? This is not a required part of the question, but it might make sense to help you see what's going on, is you might want to just take a second and immediately calculate cost minus accumulated depreciation and figure out that book value amount. So in this case, it tells us the cost was $126,100. The accumulated depreciation was $92,200. And if you did that, you would see that that brings our book value to $33,900. More than that, though, what that tells you is that if you sell this or you receive, however you do this, less than $33,900 worth of value, then you will be booking a loss. But if you receive more than $33,900 worth of value, then you will be booking a gain. And so it'll help you identify pretty quickly how these entries need to look before you even dig into the math or the specifics of each individual situation. Finally, for situation number 4, DS sold the machine for $40,500 in cash. We'll start with the easy part. Debit cash, $40,500. Debit accumulated depreciation dash machine, $92,200. Credit my equipment or my machine for the $126,100. And now you say, well, what's bigger, 40 plus 92 or 126? And of course, 40,500 plus 92,200 will be the larger one, and that is actually equal to 132,700. That difference then tells me that I can go straight away and book me a gain of 6,600, and in this case I will go to gain on sale of machine for 6,600. So cash goes on the balance sheet, it's going up. Accumulated depreciation machinery goes on the balance sheet as a contra asset. Since it's being debited, it is going down. Gain on sale of machinery is similar to a revenue, so it's going on the income statement as a credit. So it is going up, and the machine account itself is an asset that goes on the balance sheet, so it is coming down. So hopefully after watching this video, you feel pretty comfortable with exactly how we account for long-term assets, how all this works together to help us organize this information and help us put together good, solid financial statements for our users. So hopefully that made sense, and we'll see you next time. Thank you.